Welcome to Aging Empowerment by GolderCare Solutions. Our topic this time is insurance, COVID, Medicare, and public entitlements. I am Gail Glockoff-Long, and I'm the insurance specialist for GolderCare. What is GolderCare Solutions? GolderCare is an independent advocacy group solving long-term care problems. We use a comprehensive approach focusing on quality of life and asset protection. We navigate the complexities of long-term care, advocating for our clients and those that care for them. Today, we're going to try to demystify insurance, how it works with Medicare and public entitlements, and the effect of COVID on insurance. Let's start with the basics. How does insurance work? Now, it doesn't matter if we're talking life insurance, car insurance, homeowners, health insurance, annuities, they all kind of work the same. An actuary estimates the claims that will happen per year. So out of 1,000 people with homeowners policies, how many are going to have hail damage, and what's going to be the cost of that hail damage in a given year? How many people age 80 are going to die in a given year, and how much insurance do they have? $1,000 policies or $1 million policies. Then actuary estimates those claims per year. Then the insurance estimates what is going to be the growth of money. All those premiums that go in are invested, and they grow in either bond funds or stock funds or real estate. They have different investments. How much is that going to grow per year? The higher the growth, that calculates in, then there's more money there for claims. Premiums are then calculated based on the estimated claims, the estimated amount of growth, and then they figure what do they need for premiums to match that. Premiums are usually locked in for, in some cases, for a year. In some cases, it may be they're locked in for the lifetime of the policy. So the actuary has to do some estimations here as to how many claims are coming in versus how much money is coming in to offset those claims. Risk plus interest growth equals the premium amount. So with that, when claims are higher than expected, or the interest investment return is low, then the only way that the insurance company can make up for that is for the premiums to go up to make up for that difference. Right now, what did we have in 2021? COVID deaths. We had a lot more deaths than anticipated, which would have affected the life insurance costs. COVID illness. Think of the costs for healthcare insurance for both the extensive medical treatment needed, for the hospitals, the cost of the PPE equipment, the cost of the ventilators, all of that raised the healthcare costs. COVID testing. That came in to effect both for the healthcare world, but also think about your long-term care facilities. They had to constantly test all of their residents, and those would then be charged toward that resident's healthcare insurance. Now, for the facility itself, they also had the cost because they had to buy and pay for the testing equipment for all of their employees. So there were higher costs for both health insurance and for the long-term care facilities. What did the COVID lockdowns? What were the effect of the COVID lockdowns? Well, this was more of a cost of business. If you have a business that needs customers coming in the door, then with the COVID lockdowns, you did not have those customers coming in. So a lot of businesses did not have the income they anticipated, so they're having trouble paying for their business insurance. And a lot of businesses went out of business. So there was a cost for the insurance companies that write business for businesses to protect them. Now, add on top of all those COVID expenses, think of the natural disasters that happened in 2020. Our neighborhood alone had huge hail damage in April. Every single house in a 4-block square has a new roof now. And I would say 60% of them have new siding, and maybe 10% have new windows because the hail actually broke windows. It was that bad. Then a couple of months later, we had the derecho, which took down the trees, and the trees fell on the house. With the new roof, they got another new roof. There was the fires out west, the floods, and hurricanes. So all of those affect your homeowner's insurance, your property casualty insurance. Many cars had trees land on them, so that affected that insurance. So regardless of what type of insurance you're thinking, think of all the disasters that happened in 2020 that were caused either by COVID or natural disasters. So how does that affect you? There's a hidden COVID cost. When with insurance prices, because of all of these high expenses in 2020, the insurance costs are going to go up. Expect any insurance you have, expect it to be more expensive in 2021, 2022, 2023. It's going to take a couple of years for all of that to catch up and balance out again. So your insurance costs are jumping up. Your first thought is, oh, I'll just change companies. I'll find one that's less expensive. But be careful. Here's the hidden trap. With a lot of the COVID costs that the companies had, they're doing everything they can to keep their liabilities down. And so many companies are not taking on any new clients. So you may, if you drop your insurance with one company, you may not be able to get any insurance with a new company. I know when we were looking for company insurance, our corporate insurance renews in April. And so we all, we look around, we work with the same broker, but they look around at which company is going to be better. And they told us that they checked with 6 companies, and 5 of the 6 were not writing any new business. And the 6th one was extremely limited in what they were writing. So fortunately, we had a good company. We liked the company. We stayed with them. So if you're looking to move companies, make sure you work with your insurance broker and you have a new plan in place, that you have been accepted somewhere before you drop your old coverage. Now, if you can't get new coverage and your current coverage is too expensive, again, work with your broker. Maybe you can modify your current plan so it's more affordable. Maybe there's one of the bells or whistles that you can eliminate for right now to make that plan a little more affordable. Now let's look specifically at Medicare plans. Traditional Medicare is mandated to cover certain things. And your Medicare supplement plan is also by law, it has to cover certain things. They cannot change that. Your Medicare supplement plan may go up in cost, but it can't really change what it covers. Advantage plans are different. Advantage plans work as a pool of money. Medicare says, okay, private insurer that is selling Medicare Advantage plans, we will give you X amount of money per person that you sign up. And you have to figure out exactly how you use that to cover all of the expenses they're going to have, and to cover all of your operating expenses, and to make a little bit of profit so you stay in business. And what Medicare Advantage plans do every year is they change their formula of what they offer. Sometimes they offer free gym membership. Sometimes what they offer is they'll add in a dental plan for free, or a dental plan. Maybe the next year, the dental plan will cost you $20 a month. They change that every year. They may offer eyeglass coverage 1 year, they may not the next. So what I want to warn you is make sure when you get your book, you'll get your book in the fall, and it tells you about the plans coming for 2022. Expect more changes, more than normal. The normal is, this is what drugs are covered in each tier, and the cost of the tiers will adjust a little bit each year, and maybe some doctors drop in or drop out of their plan and new doctors are added in their plan. They'll just be minor changes. That's the normal. Expect a lot more this year. They will expect them to have fewer extras. They use, when they don't have a lot of claims and they have a lot of money, they have some extra money, they add the enhancements so that you'll sign up for their plan instead of somebody else's. So be aware that if dental coverage and vision coverage are really important to you, check and make sure they're still offered in your plan. That may have changed. Expect higher drug copays. The doctors in your plan may have changed, so you will want to make sure that your doctor is still in the plan. If the particular doctor you go to is not important, then that's not a big deal. But if the doctor is important, make sure they're still in your plan. Review the changes and make sure the plan is still right for you. But then again, look at the bottom line. Don't drop coverage until you have a new plan in place. So again, work with your insurance agent, your insurance broker. If the changes that you get in the book, if the changes are something that you think are no longer appropriate for you, then make sure you have a plan in place, that there is someone, that a company that has accepted you will accept you before you drop the old one. Specific types of insurance. Let's look at how things change as we age. There are things that surprise you about insurance issues that change as we age, and we don't even think about them. So I'm just going to give you a little bit of education of things to be aware of. There are many decisions you must make, and our goal is to educate you to help you on that aging journey. Homeowners insurance. Did you know your home is generally not covered for fire or damage if it's unoccupied? And that doesn't mean you went out of town for the weekend and something happened to your house. You'd be covered for that. But if you are a snowbird and you're away for 4 months in the wintertime and something happens to your house, they may give you your premium back. And why is that, you ask? I mean, it doesn't make any sense. Well, if you are in your home, you are more likely to notice little things before they become a big thing. If you're in your home, you're more likely to smell smoke, or when it's a little bitty fire and you call the fire department before the house is totally engulfed. If you have a leak in a faucet, the leak in your washing machine hose, so there's water, well, your home, you see that, you turn off the water at the main water spot, and you resolve that issue before it becomes a big deal. If you're not in that home, that broken hose on your washing machine could put water all over your basement. And if it's wintertime, that could freeze. There could be major damage to your home before anyone notices it. So that's why you may not be covered if your home is vacant. If you move into assisted living or a nursing home, again, your home is going to be vacant until that home is sold. So check with your homeowner's insurance agent and see if you need to have a special rider on your house. It will cost a little bit, but it'll be well worth it if something were to happen, because that will cover you during that time that the home is unoccupied. So if you move into nursing home, assisted living, your intent is to get your house fixed up a little bit and then sell it. It may be on the market a while. Make sure that we have that extra coverage. Make sure you have that extra coverage for those months that you are down in Florida or Arizona. Long-term care insurance. Wow, this is one that people just totally glaze over when they come into our office. They will bring in the piece of paper and say, I've got long-term care insurance. I have no idea what I have. They don't even know where to start with it. So there are some things to look for. The most important page, it's usually page 3 of a policy, page 2 or 3, somewhere right at the very beginning, and it gives the specifics of your coverage. Then after that comes a definition page, and then usually more detail on the different provisions of your coverage. So an important thing to know is, when does your coverage start? Long-term care insurance was designed to go with the old Medicare. And the old Medicare said, well, you had up to 100 days of rehab care, and then we don't pay anymore. So many of the long-term care policies do not start paying until day 90 or day 100. Then they will start coverage. The other reason for having that, you usually get a choice when you bought your long-term care insurance. You would get a choice of when you want it to start. It could start immediately. It could start on day 20, 30, 60, 90, 100. Those are kind of the standards. The earlier you have the long-term care insurance start, the more expensive it is. So one of the ways that you probably chose to keep your premium down was to wait until day 60, day 90, day 100. So you need to know that so you can plan around your private pay costs until that long-term care insurance starts. Another good question to know the answer to is, does it cover assisted living or in-home care? The old insurance for long-term care insurance was designed to cover nursing home, period. And the reason was assisted livings didn't really exist at that time. And so there was no provision for them because it wasn't an entity at that time. The newer policies, some of the policies say for assisted living, they will cover often at 50% of what they pay for nursing home. Sometimes it's only 25%, but that is something for you to know. In-home care is often paid at the rate of the care, or there'll be for in-home, say therapies. If you're doing them in-home, they will often pay for $25, $40. There may be a limit to how many they will pay on a given day. And why that's important is, if you are getting physical therapy and speech therapy and occupational therapy, you may not be able to have all of them come on the same day. They may have to alternate days depending upon your long-term care coverage. So that's what you'll want to know. What is it that you have? So how much does it pay and what does it cover? That will be found on that page 3. It's called a data page, a spec page. It'll be a page that's laid out with basically a lot of numbers. It looks different than the rest of your policy. And it will say, we will pay X amount per day, or it may say we pay X amount per month. And the older policies started at around $50 a day. And some of the newer ones, they might pay $250 a day. It will say what it pays. And the next question that goes with that, well, how long does it pay? Does it pay 36 months, 60 months, 5 years? Is there a lifetime bucket? Some of the policies state a specific amount that they pay per month, and then they tell you exactly how many months. Some will say you have a bucket of 150,000, and when you use up your bucket, then you're done. You've used up your long-term care. And having that bucket means if you use it for assisted living, which is paying half the rate, it's going to last twice as long. Or, you can use up a chunk of it in assisted living at the half rate, and then you still have a bucket left when you go into full nursing care. So it's, you have to look at that. There are a few policies that say they have a lifetime bucket. There is no bottom to the bucket, but there is a limit per day. And some of those policies also had an inflation factor. So when you bought it, it paid $100 per day, but it went up 5% each year for the first 20 years. And so what's it paying now? That's all in this calculation of what is it paying. So looking at that data sheet, page 3 of your policy, that tells you what was true at the time the policy was sold. That does not tell you what is true today. We have to do some calculations to find out what's true today, or call the company and find out what the current values are. The amounts on the data page they tell the story of the amount and how long and if there's a bucket, but it does not tell you if it included assisted living or not. You're going to find that in the definition part of your policy. I tell people I translate from insurance to English. I have in a prior position, I worked writing contracts for life insurance and annuities. And with that background, it's what is gibberish for most people are words that make a lot of sense to me. And they're kind of terms of art. They mean specific things in the insurance world. So it's helpful to know exactly what that term means in the insurance world. Now, say you were not able to buy long-term care insurance. If you can buy it, fabulous. Right now, it is more difficult to buy long-term care insurance. And one of the factors that is newer to get you disqualified is for joint replacements. When you think of long-term care insurance, it's different than thinking about life insurance. With life insurance, the question is, are you insurable? Are you likely to die in the next few years, or are you likely to have a long life? And they look at things that cause mortality. Do you have heart condition? You're more likely to die sooner. So you're probably going to be rated and pay more. But if you have something like a joint replacement, that's not going to shorten your life generally. However, it does make it more likely that you're going to end up in nursing care sooner than somebody who has not had a joint replacement. That is the statistics that they're working on. So it may disqualify you from long-term care. So let's look at some options. If you don't qualify for long-term care, what can you do to set aside some insurance for long-term care? There are now available different combo policies that are relatively new. They're not as old as straight long-term care policies. So the combo policy will combine, LTC is long-term care, will combine long-term care and life insurance, or long-term care and annuity. You put your money in, you don't have to meet all of the requirements that you normally would have to meet for underwriting for long-term care, but you do have to meet the requirements for underwriting for life insurance. And the option, what it gives you is the option of using that death benefit from your life insurance, using it up earlier for your long-term care. It means that there won't be as much money left as a death benefit, but it does give you a pool of money that you can use for long-term care. With an annuity, it works similarly. It has even less healthcare requirements for that. And the amount of money that you put into the annuity then is used up for your long-term care, and there won't be that much left for, other living expenses. If you had planned on that for your retirement, for your spouse's retirement, if you use it up for your long-term care, it's not there as an annuity benefit. What are the other options if the premiums are too expensive? This is, again, something that, working with your insurance agent, insurance broker, they can often come up with a modification to your policy to make it a little bit more affordable. So you don't have to actually drop that long-term care insurance. I know long-term care insurance rates have been going up, and I can't tell you how many people we've had come into our office saying they were going to drop it, and we figure out a way that they can keep that insurance in place for a longer period of time. Sometimes you can look at how long is your long-term care insurance paying. It may be worth it, instead of having it lifetime, maybe you back it off to it's only going to pay for 5 years or 3 years or 2 years. Is that still a benefit? Yes. For some people, that's all they need. For other people, those 2 years give them an opportunity to restructure some things, where assets are held. They restructure them so that they may be able to qualify for Medicaid. In some cases, when we look at Medicaid, they always look at gifting. If I did gifting 3 years ago, there would be a big disqualification on the Medicaid side for me. But if I could use long-term care to pay 2 years, that would get me through that 5-year look back. So long-term care, having long-term care for 2 years is still better than no long-term care. It gives you some time to maneuver what may need to be done to get you ready for Medicaid. What is an Iowa partnership policy? Explaining an Iowa partnership policy would be a whole hour in and of itself. So the real short answer is it's a partnership with Medicaid that, if you have an Iowa partnership policy, which is not available in Illinois, but if you have an Iowa partnership long-term care policy, what it allows you to do is keep more than the $2,000 when you apply for Medicaid. How much you can keep, that's a long explanation with a big formula that we're not going to get into today. But if you have an Iowa partnership policy, that's a big plus if you apply for Medicaid, and we would walk you through how to do that so that you can apply before you have to spend down to $2,000. Life insurance. I bought life insurance years ago. What do I have? I have no idea. This is very common, especially for people that their parents or grandparents bought a policy for them when they were a child. They don't know what they still have. And they know that there's a policy, or they may or may not know that they have a policy, but does that company still exist? That's one of the big questions that comes up. And who is listed as a beneficiary? If you bought a policy since the late 80s, by law, they are required to send you a notice every year to remind you that you have this insurance policy and what the current values are. That's not true if it's a term policy or if it's a term policy through work. But if you own a whole life, a variable, universal life, that type of a policy, then you're going to be receiving a statement every year to remind you what you have. The reason is people had these old policies and they didn't know what they had for insurance. And that statement will give you the current benefit, the surrender value, the insurance amount. It may or may not list who the beneficiaries are, but it's going to give you that information. If you have an older policy and you do not receive annual statements, what can you do? There are a couple of different things. If the company is one that, like Prudential, you know it's still there, it's going to be there forever. You can contact Prudential and say, I know I have a life insurance policy that was bought for me, whatever, but I can't find the policy. They will need to verify who you are, and you can order a duplicate policy or a duplicate summary of the policy so that you know what the coverage is that you have. What if the company no longer exists? That is a very common problem. The insurance commissioners, people think their job is to regulate insurance premiums. That's only a little part. The main part of their job is to make sure that a company is solvent, that their premiums are high enough to keep the company solvent. And if a company has to dissolve, that there is some company that takes over that company's policies, buys out the company, or in some way, all of those insureds are reassigned so that there's someone there that will make sure that the policy is paid when it comes time for the claim. Every state has an insurance department, a commissioner, a superintendent of insurance. They have a couple of different names, but the insurance department will have a website, and you can put in the name of, XYZ company. You found this old policy that your parents bought you, and it's with XYZ insurance. You can go onto the website and find out, okay, XYZ insurance was dissolved in 1995, and it was bought out by the Hartford or Mass Mutual or Prudential, or it was a fraternal and it was taken over by Modern Woodmen, or one of the other, Lutheran Brotherhood, which is now no longer Lutheran Brotherhood, it's Thrivent. So that would be one of those that the two insurance companies combined and now have a new name. It will give you the contact information of the new company so that you can contact them and check on your policy. One important thing to remember is who is listed as the beneficiary. Generally speaking, people, when you buy your own policy, you usually list your spouse and then your children, or if you don't have children, you'll list maybe your parents or your siblings. Here's a couple of problems that we have actually seen. The person, maybe the insurance was bought for you by your parent and you're, a minor child. So they list themselves, and then maybe they list their parent who is still alive and active as the backup. And there are no other beneficiaries listed. Well, now all the beneficiaries have passed away. So look and see who's listed as beneficiary. That's not a huge deal if you get along with everyone in your family, because if there is no beneficiary listed, every state has a way of distributing that money. Usually the state plan is it will go to your spouse, it will go to your descendants. If there are no descendants, there are no children, then it usually goes up to your parents, to your siblings. There's a plan that the state has. But here's where the problem comes in. If you listed your spouse and then you got divorced and you forgot to change your life insurance, which is easy to forget, then everything may go to your ex-spouse and not to your children where you want it to go. So make sure you know who's listed as your beneficiary. I have life insurance with work. Can I keep it if I apply for Medicaid? Maybe. It depends. That's the answer. Depends on what type of insurance, how it's listed. If it's truly a term, it has no cash value, and then it could be kept and it goes to whoever you list as the beneficiary. If it's any type of insurance with a cash value, chances are it will have to be surrendered to apply for Medicaid. That is something that we look at, how the policy is structured and what the values are as to whether or not it can be kept. There are specific limits within the Medicaid rules as to what can and cannot be kept. The nursing home told me to cash in my husband's life insurance before I apply for Medicaid for him. Are there other options? Yes. And again, it depends on the individual situation. We have had cases where a person had a very large insurance policy with a large cash value and wanted to apply for Medicaid for their spouse, but they were going to be over asset limits. But we were able to restructure that in such a way that they qualified for Medicaid for her husband. She did not really have cash, and this would be a financial burden to have had to cash that out, but she could take a loan on the insurance and then take that money, do something different with it. The money comes back, we put the money back in the life insurance. There are ways of maneuvering around that, but every case is different. So the nursing home is going to go by the simplest bottom line of cash everything in, spend down, apply for Medicaid. And what I want you to be aware of is there may be options. So you need to check with an expert on how to plan for Medicaid in order to see if there are any options for your community spouse. And the options are different if you're a single person and you are the one that's going to be going on to Medicaid versus if you are a couple, one is going on to Medicaid and the other is going to be the community spouse. Or if there are disabled children, there's a lot of different options in here. And so every case is unique. Annuities. Mom has lots of annuities and just went into nursing care. I am the beneficiary. Do I have to surrender them all now and take the tax hit? The answer again is maybe. And it goes with the next question. Dad has qualified annuities, investments, and savings. What do I take first for nursing home costs? Again, this depends if it's a single person or if it's a couple. And usually the adult children are helping both parents. So this may be a situation where mom has money in her name, but there's a couple. And we may be able to move things to the to the spouse's name in order to qualify for Medicaid. There are a lot of variables in here, so each individual situation is different. And what you need to be aware of is, do not accept the blanket answer from the nursing home. Make sure you talk to someone like GolderCare that really knows what all the options are and can look at the complete situation and a comprehensive approach to determine what needs to be used, what can be saved. And when we look at, yes, we are going to need to be using our savings, which accounts do you use first? There are tax advantages to using those qualified funds before we go through our savings account, because when's the best time to take a tax hit? When you have an offset of a tax benefit. And if you can use those qualified monies at a time when you have a high medical cost, that the two taxes may offset each other. You have a tax benefit for medical costs, and long-term care would be a very high medical cost that may offset the tax hit that you take for taking out qualified monies. So that's, again, part of the balancing act that we do as to which monies do we use first and when. If I'm rehabbing from a medical event, Medicare pays for everything, right? That would be a definite wrong. Medicare pays for rehabbing when they determine that you are making progress to rehab and get better and go home. So they will pay for a certain number of days of rehab. If they determine you're not making progress, and why would you not be making progress? If you are someone that has advanced Alzheimer's and you're not able to follow instructions, then you're not going to be able to cooperate with the rehab people. And so they will determine that you're not going to make any progress, and they will shorten your rehab time because you can't follow their instructions. When the rehab team determines you are not making progress, they will notify Medicaid and they will quit paying for rehab. Now, it's possible that another facility could have more success with you, but the answer is they're not going to pay forever for rehab. There's a limited number of times. And during that time, yes, they are paying for all of that custodial care or the rehab time at the long-term care facility. But Medicare does not pay for custodial long-term care. That is a myth. We have had many people say, well, we'll just go into the nursing home and Medicare pays for that, right? No, it does not. It does not pay for custodial care. And how it pays, it depends on what kind of coverage you have. What people are used to is the rules of the old traditional Medicare. And because that was what we had for so many years, traditional Medicare said they definitely paid the first 20 days at 100%, and then there may be a copay from day 21 to day 100, and that copay may change during the different, depending on how long you're in rehab. And that has changed if you're talking about Advantage plans. And Advantage plans are not all the same. One Advantage plan may say, we pay only after the first 20 days. You pay a copay for the first 20 days, we'll make up the rest. And then after 20 days, we'll pay 100%, which is the opposite of traditional Medicare. Other Advantage plans say, no, they will pay 100% for the first maybe 30 days, and then it adjusts after that. So they all are a little different. You have to look at what your plan says. And depending on if you're on a traditional plan and you have a Medicare supplement, that may make up the difference for the copays. You just have to look at exactly what you have. Talk to your agent. We can help you sort that out also. But they do pay for something. But again, whether you have traditional or Advantage, they are only paying for the rehabbing. They do not pay custodial long-term care. For custodial long-term care, the only options you have are out of pocket or your long-term care insurance and or Medicaid. That's about it for your long-term care. So our conclusion is know what you have for insurance coverage and make sure your helpers and families know. We have people come in all the time and dad fell and dad's in the hospital right now. And we think he's going to have to rehab, but we don't think he's going to be able to come home. And so we ask, what kind of insurance coverage does dad have? We have no idea. And that's difficult if your family doesn't know what you have. It's hard to plan around an unknown. As we saw in the last slide, the Medicare may pay the first 20 days of rehab. They may have a copay for the first 20 and not start paying until after that. They may pay for 10 and then you have to prove you're still needing rehab for them to pay more. So that's all important when you figure out what are you going to do. There is no magic answer and there is no single solution. The solution is individual in every unique situation. But it all starts with knowing what your coverage is and making sure that your family members know. Where do they find your policy? Where do they find your book? You get a book every year if you're on Medicare. If you're not on Medicare yet, you'll get information periodically, but you may not have it all in one place. So it's important to put the insurance information in one place and make sure your family members know where they can find that information. So get professional help when you need it. It is very overwhelming if you have not been actively involved with this area of your parents' life, and you suddenly are thrown into it, or if you are a spouse and you've been healthy, the couple has been healthy, and all of a sudden one has a major medical event. You're now in a realm that you are not familiar with. And it is very, very easy to become overwhelmed. You're getting advice and recommendations from a lot of people that have a vested interest in their business and not in you. So a hospital is going to say, well, we think you need to, we think that the person can stay here for X number of days, and then we need them out, and you should go to this one facility to rehab. And that they're recommending that not because that's the best facility. They're recommending that facility because it's part of their ACO group. And so it's to their financial benefit for you to go to that facility. It may not be convenient for your family, and it may not be the best in whatever you need to rehab, but it's in their group. So they're going to tell you, you need to go there. And, oh, by the way, somebody is here to sign you up right now. We have somebody waiting out there to sign you up for that. You have to look at it from a more complete approach. Is that a facility that's going to offer what I need? Is that a facility that's going to be convenient for my family to come and visit me while I'm rehabbing? And is that a place that, if I can't rehab well enough to go home, is that a place where I can stay that I'm going to like, that's going to be convenient for my family? And is that a place that will take either my long-term care insurance, or if I need to go on Medicaid, a place that will allow me to stay and have Medicaid? Or am I going to have to move again? So these are all questions to look at. It's important to consult with an advocate who is focused on coaching you through the decisions you make as you age. You want someone that's focused on your best interest and not just their convenience of moving you out of their facility or moving you to one place or another. What is going to be the best for you and your family situation? Every situation is unique, and you need someone on your team to help you make those decisions. It is so easy to become totally overwhelmed. You're under stress, and now you have 50 questions coming at you. It's very easy to become overwhelmed. You need an advocate on your side, someone to boost you up, give you the courage in your decision making, help guide you in that decision making, and to be your back and be that voice with you if that's what's needed. So I'm sure you have a lot of questions. As you think of those, I want you to know that we're here and available to answer those. You can email them to us at info@goldercare.com. You can call us 309-764-2273. And you can also look at our website. We will be posting this presentation along with our other empowerment presentations. They are usually posted on our website a couple of days after the presentation. And we have a lot of other information on our website that can help guide you through your decision making as you age. GolderCare helps put the pieces together to help you achieve your aging objectives. We've got a multi-specialty team. We have expertise in medical, public benefits, insurance, finance, veterans benefits, and legal issues. We can help you through that aging objectives, whether you're 60 and you are now aging solo because your spouse has died, or maybe you never had one, but you suddenly realize, oh, there's some issues coming down the road I need to be aware of. We can help you at that step. Or maybe it's time to move into some kind of senior complex. We can help you at that step. We can help you access public benefits, veterans benefits, and help you through the financing of how are we going to pay for this long-term care. It all starts with a phone call, and our number is up here in red, 309-764-2273. So your next step is give us a call, and we will guide you as to how we can help. Thank you for attending today and for viewing our aging empowerment presentations. We will be posting a new one every month, and we hope to see you at our future presentations. Thank you again for joining us today.